Hey YouTube, Ron here with another book review. Today's book is The Gone Fishing Portfolio by Alexander Green. Get wise, get wealthy, and get on with your life. So, really interesting book. It's just under, actually it's like 174 pages of actual content, and then there's appendix. So really well under 200 pages for this book. About the author, Alexander Green is a former money manager. Used to manage money for people in the 80s and 90s. Then he retired from that and became an author and started writing about investing topics. And it's, I finally got around to reading his book. I've had this book for a while. It's just been in my queue to kind of get through, and I had a recent trip, so I had time to read through this book, and it's actually really, really good. This book, if I had to say, let's say you were a person that wanted to decide you wanted to take on investing yourself, and you didn't want to, you wanted a very simple recipe for that for the most part is going to be successful. This book, I'd say, is definitely among the ones that I would recommend that outline a formula that you could follow. Again, Alexander Green did this for a living. He managed people's money for a living, so he's made a lot of mistakes, and he knows a lot of the myths associated with managing money, and his wisdom really comes out in this book. So the idea is, he first discusses why you should consider even managing money yourself. I mean, most people think that investing is such a complicated topic that for the most part it's best to hand the control of that over to someone else, to an investment professional, and let them deal with it. And he goes into all the arguments as to why you won't necessarily want to do that. I mean, he is, again, this guy used to do it for a living, and he's telling you a lot of reasons why you won't want to. Because something I've said in my previous videos, and if you read any of my blog posts, I say the same thing, that no one's going to care about your money as much as you do. And with the proper education and a little bit of time to learn what you need to know, it's something you can definitely do yourself very successfully. So, get on with the book. So the idea behind the title of the book, The Gone Fishing Portfolio, is that he outlines a portfolio that doesn't require a lot of oversight. Literally, what he discusses is a portfolio that takes an hour to build on Vanguard, if that, and that you're going to look at maybe 20 minutes a year. So pretty much you build a portfolio that's based on index funds, and then once a year you go in and you rebalance that portfolio. So when things get out of whack, you rebalance it to get back into the allocations that he recommends. So it's, again, really, really good book. As far as the portfolio he lines out, I agree with a lot of it. There's some things that I don't do, but again, but I'll step through each one of them, what he recommends, and explain why. So he recommends a 30% weighting in U.S. stocks, so large cap, small cap stocks. So you own stocks like Apple, Facebook, General Electric, and then some small cap stocks. So companies that are worth $10 billion or more, and companies that are worth much less than $10 million. So you have a broad spread of American business. So 30% in that. 30% in international stocks, and that's broken down into three major sectors. So European stocks, Asian stocks, and emerging markets. So places like, China's still technically an emerging market, but places like India, Brazil, places where, countries that were once third world that are now emerging out of that and are in heavy development phases. So pretty much full coverage of the international investing scene. And then he has a 30% weighting in bonds of various types. He has 10% in high yield bonds, also called junk bonds. So which for a high yield bond, it's any bond with a rating, a BBB rating or lower, that's considered high yield or junk bond. High grade bonds, so investment grade bonds, and then 10% also in TIPS, or in treasury inflation protected securities. So they are a bond, a T-bill that is indexed against inflation. So it's a bond that's always pretty much guaranteed to keep up with inflation. So he has you doing 10% in high yield bonds, 10% in high grade bonds, and then 10% in TIPS. The remaining 10%, he has 5 of that in REITs, so real estate investment trusts. So if you don't know what a REIT is, check out my blog on my website, ron-henry.com. I have an excellent post that I wrote on REITs explaining why you might want them. But in a nutshell, what REITs are is a very simple way to, it's a way to invest in real estate. So REIT stands for Real Estate Investment Trust, and what it is, it's a business that manages, operates, or finances real estate properties. So REITs are a way for you to basically own or benefit from the advantages of owning real estate without all the hassles of owning real estate, if that makes sense. So that's the 20-second explanation of REITs. And then the remaining 5% is in gold shares. Now, not necessarily investing in gold, but investing in basically in companies that mine precious metals. So like BH Billiton, companies that's an example of companies that basically mine silver, gold, precious metals. So to recap, 30% in U.S. stocks, 30% in international stocks, so that's 60, 10% in high yield bonds, 10% in high grade bonds, 10% in tips, and then 5% in REITs, 5% in gold shares. The reason why he constructs the portfolio this way, and it's not necessarily a portfolio that is going to produce the absolute greatest returns, but what he's done is that he's made stocks the heaviest portion of the portfolios from a weighting standpoint, because that's what's going to give you a lot of your return. And then the 30% weighting in bonds is going to take a lot of the volatility out of the portfolio. So what hurts a lot of people when it comes to investing, especially when you're buying stocks, individual stocks especially, is the amount of volatility. You can, based on an earnings report, a stock can lose 15, 20%. I mean, that happened with Facebook here recently. So that kind of thing is a very real possibility. And most people, just from a psychological standpoint, have trouble with that. So the portfolio is 60% stocks, which is going to juice up your returns, is going to get you, which is going to get you the returns, the benefits of owning American and international business. And then you have 30% weighting in bonds of various types to take some of the volatility, to kind of smooth out the ride a little bit, if that makes sense. And then 10% in alternative investments, so like REITs and precious metal mining companies. So what's nice about this is he outlines portfolio, like what I just explained to you, and then he also discusses individual Vanguard index funds that you can use, low-cost funds you can use to actually build this. So it's not like he just provides a generic recipe saying, hey, buy 30% U.S., 30% international, 30% bonds, some REITs, and some gold shares, and be on your way. He actually lists the actual securities that you can purchase. And again, this guy's not making any money off it. Vanguard is non-profit for the most part. It's owned by everyone that owns Vanguard index funds. So it's not like he's making a commission on making this recommendation. And I've actually gone through all of them, and they are if I were recommending international index fund and a U.S. index fund and REITs, the ones that he recommends are the exact same ones I would. I don't personally have any holdings in gold companies. I just fundamentally just don't believe in buying gold. But again, owning or companies that are in the business of mining gold. But I mean, I understand his position. It's only 5%, so it's not going to really hurt your portfolio. And traditionally, whenever the market is recovering from some kind of correction, people pile into gold, so those kinds of companies tend to do well. So I understand why he includes them from a volatility standpoint. A great aspect of this book, because here's the thing, when it comes to investing, the mechanics of investing is actually the easy part, right? It's like telling you where to put money and what weightings. That's easy. I mean, anyone you can teach a 13-year-old how to do that, and they can be pretty successful doing that. It's relatively easy. It's whenever things go badly, whenever there's bad news, or for whatever reason the market it goes under correction, or there's just whatever. I mean, because people are just very emotional. People are very emotional, and they do tend to do that are otherwise smart tend to do very, very silly things with money whenever there's reports of trade issues, or the price of oil is tanking, or or whatever. So what's good about this book is that he doesn't necessarily only outline the weightings and the actual index funds to buy, but he also spends, like in chapters 12 and 13, he talks about having realistic goals and expectations, the importance of rebalancing, and he talks about psychology a bit, which is something that I stress a lot when it comes to investing. I think that when you're getting into investing, the most important, or the things you should focus on first, forget like actually buying anything, get an understanding of how stocks work, what you're actually buying, that you're buying ownership in a business. You're not buying like a ticker symbol, like a casino chip, and understand human psychology, and that just innately we are all predisposed to do silly things whenever we hear bad news, and the importance of being able to to gate that, to kind of hold that back, to keep it in perspective, and to use accurate thinking in your investment making process is going to make you very successful. So the fact that he covers that in chapters 12 and 13 in the book is very good. Again, some of the advice he gives here, give like 4 things to help your emotional quotient. Like 1, do a reality check. Recognize that investing in stocks means your account value is going to fluctuate from time to time. The concept that you buy a security or you put money in an investment and that the trend line looks like this, so it's just like straight. It's a straight linear progression, is just not reality. Like nothing in nature really works that way, and for some reason we think that whenever we put money in an investment, there's never going to be any fluctuations. Anytime the price drops, it's a bad thing. I mean, the best way to think about investing is that you're gonna, for the most part, over any 3-year period or 3 to 5 year period, it's going to be like 3 steps forward, 1 step back. So you'll have like 2 years where there's going to be nice appreciation, and then maybe a year where the market's either flat or receding. And that's just the nature of the ebb and flow of business, ebb and flow of the stock market. So number 1, be realistic. Number 2, automate your investments. When you don't have to think about things all the time, whenever you say I'm going to implement this portfolio, and every time I get paid, I'm going to put a portion of my money into these index funds that in the asset allocation that you said you're going to go with, it makes it very simple very easy to be successful, because you're not something you have to think about. You just kind of letting the automated aspect of you putting money into the investments on a regular basis just do its thing. Act unemotionally. So he talks about rebalancing. So once a year, when he says rebalancing, what he means is, when you have this allocation, so 30% U.S. stocks, 30% international stocks, 30% in bonds, it's not like over the course of a year you're going to make that weighting is going to stay the same. It's very likely that might be a year when U.S. stocks are doing very good, so that might become 35 or 40% of the portfolio based on the appreciation of those index funds. So what he's talking about by acting unemotionally is that you have your asset allocation once a year, regardless of where things are. You're going to sell out of securities that are really have become a larger portion of the portfolio than they should be, and you're going to put that into the ones that are lagging behind to maintain that balance. So that's good, really good advice. And then the last one is sit on your hands. And this is advice you hear Warren Buffett says, inactivity strikes us as intelligent behavior, meaning that the reason why you're doing all this is so that you're implementing the gone fishing portfolio, meaning you do it, you set it all up, and you just let time do its thing. So it's really good that he added this to the book, because honestly that is the thing that is most likely to make you be unsuccessful as an investor. Your psychology and just doing silly things at the wrong time is what hurts most people when it comes to investing. He also talks about the importance of time, the importance of getting started now, because compound interest is a beautiful thing. If you start putting money into investments, first 2, 3 years, 5 years, you typically don't see very much. When you start getting to the 7-year point, like the way the money begins to compound and take on a life of its own is really going to blow your mind. So the importance of time when it comes to investing is more important. So time in the market, meaning the amount of time you are in the market, is more important than timing the market. Meaning whether you buy when stocks are high or stocks are low, over an investment career doesn't really matter. But what is important is that you get started. That you get your money into it, you regularly put money into that, and you just let compound interest do its thing. There's a really good poem, and hopefully maybe one of you guys can say who wrote this, because he doesn't know either. It says the author's unknown. I wanted to read this to you guys, talking about the importance of time. It says, imagine there's a bank which credits your account each morning with $86,400, carries no balance over from day to day, allows you to keep no cash balance, and every evening cancels whatever part of the amount you fail to use during that day. What would you do? Right? So think about that. If you had a bank that handed you $86,400 every single day, if you don't use the money, you lose it, what would you do? A smart person, you could take it all out, right? You can withdraw the money. And that's continuing the poem. It says, did you draw it out? Of course. Well, everyone has such a bank. Its name is time. Every morning it credits you with 86,400 seconds. Every night it writes off as lost whatever of this you failed to invest to good purpose. It carries over no balance. It allows no overdraft. Each day it opens a new account for you. Each night it burns the records of the day. If you fail to use the day's deposits, the loss is yours. There is no going back. There is no drawing against tomorrow. You must live in the present on today's deposits. Invest it so as to get from it the utmost in health, happiness, and success. So I don't know who wrote that, but it's an excellent, excellent, I guess, poem or note on the importance of time and the value of time and using it wisely, in your life to become successful. So those are my main thoughts on the book. That's mainly what I got out of it. In the afterword, he talks about, he touched on individual stocks and things like efficient market hypothesis and modern portfolio theory, things that honestly aren't really that important for the context of the point he was trying to make in this book. But just if you want to read that, also great reading as well. So really, of the meat of the matter, the meat of the book is 168 pages, and then there's about another 20 pages of additional information that I find is pretty. It's important. It's nice to know, but if you can get through 168 pages and really understand this, you're going to be in a really, really good position to handle your own investments. So again, as far as reading it, I would recommend that you read the entire book. And then chapters 12 and 13, reread those chapters at least 2 additional times. If you don't reread the entire book, that's fine, because a lot of you don't have to reread it multiple times. But the chapters on psychology, on having realistic expectations, on managing yourself, like not being emotional, not letting emotionalism drive your investment process, that's gold. That's incredibly important, and it is the thing that will make or break your success as an investor, not which securities you buy. So hope you guys enjoyed this. Again, the name of the book is The Gone Fishing Portfolio by Alexander Green. Get wise, wealthy, and get on with your life. Hope you guys enjoyed my hopefully short book review, and this one went on for a little while, but it's a really good book. I will have a link in the description to my to where you can buy this on Amazon. If you guys have any questions, comments, please let me know. Like, subscribe, share this video. And if you also enjoy investment topics, check out my website, ron-henry.com. That's also going to be in the description. I always have lots of great topics on investing, life hacks, things that I find pretty interesting. And also all my book reviews are also listed there as well. So if you want to see like a collection of where all my video book reviews are, you can go there and see the entire list. So thanks again for watching. I will see you guys next time. Have a great day.